And welcome back. Well, now we're in the situation where our relationship is on the rocks. Well, what do you mean by that? Well, things used to be nice and shiny. We used to get along well. Now we're not getting along so well, and we're considering what happens if our asset is less valuable than what it cost us to put it into service. So we're going to talk about impairment in GASB 42 now. GASB 42 recognizes that sometimes your relationship turns into a shipwreck and you need to make some adjustments to it. So you have a situation of what we call an asset impairment. So an impairment is when an asset's book value is less than fair value. So fair value is what you can get out in the marketplace for the asset. And it's not so much always what the hard assets are, but it could be that your asset's a power plant and the power that it produces is too expensive compared to what you can buy power for in the market. Well, in that case, you do have an impairment because its book value is not recoverable its fair value rather is not recoverable out in the marketplace because the power supply cost of that asset is higher than what the market will pay. So you have an impairment. So a formal definition is that the service utility of the asset has declined significantly and unexpectedly, and the usable capacity that you expected when you built it is not recoverable through your customer rates. Now the situation is unexpected because, if you would have done something in the first place if you knew that the situation was going on. So it's kind of, GASB is about relationships, but sometimes GASB is a little obvious and obtuse when it comes to how it presents itself in words for situations that we have to address. So when you look at what can cause an impairment, so let's talk a little bit about impaired asset drivers. Well, the market, as I've mentioned, for power supply costs, market is lower than what it costs you to produce the power. Maybe new technology, our new shiny objects, wind turbine power with subsidies is cheaper to produce as well. What about commodity pricing? Gas costs are lower than coal costs if you have a plant like that. Maybe you have an asset that had some storm damage that you have to recover. Laws and regulations change. Emission credits that you have to buy out in the market maybe are too expensive for you, and some laws on emissions are impacting the efficiency and cost of your power plant as well. Maybe you've lost a major customer in your community. You had a foundry that shut down and the foundry was 60% of your load. So you have that issue. You don't need the power plant as much as you did before. Obsolescence, new technology, it costs a lot more to put scrubbers on than the return on investment that you'll get through your rates. Maybe the change in manner of use. You have a building that was damaged and you convert it to a new use, or perhaps you're building a power plant, I've seen this, and then we have a construction stoppage. Supply chain issues, workforce issues, things like that cause a stoppage, could impair a construction project. But not all these examples equal an impairment. There must be two tests that you do. First off, you have to have a potential identification of an impairment. And secondly, you test for the impairment. Okay, well, what does this mean exactly? Well, you first identify the potential for an impairment. It's kind of like, I think we have an impairment going on in Houston. We have a problem. The magnitude of the decline in service utility is significant, or cost recovery is not certain. I think that's an issue. Let's go check it out. Well, then we go to step 2, which is the test of the impairment, where the cost of the use is greater than the recovery that you can get back in your rates. So here's an example. We have a power plant with generation that is often out of the money. Here's the market price for power, and right now we intersect, but say our cost of power goes up here and the market stays down here. Well, now you have an issue. You have an asset impairment because you cannot recover the cost of this power plant through your customer rates because you can buy power cheaper in the market than it costs you to run that asset. So we're looking at this and we say, that could be a problem. Let me check this out. I need to run a few spreadsheets. Well, you run your spreadsheets and you realize that, this isn't part of the normal life cycle of the asset. The power plant life is 42 years. We're only in year 22 and our costs are higher than the market. We have a potential impairment and we need to quantify it. So how do we determine the fair value of what this impairment might be? Well, oftentimes you should hire an outside independent study from a consultant. Now, you know what people say about consultants, but in cases like this, it's good to have a study from outside to verify probably what you already know internally, that you have a potential impairment. And what you would ask the consultants and yourselves to do is determine the future cash flows of the asset, which is the power plant output, times the expected market price, and compare that to what the book value is of the asset on your financials. Okay? And then you have a couple of choices. Well, if you determine there's an impairment and there's a loss, you book it and you eat it and absorb it in earnings, or you have the potential to recover it in customer rates. When we talk later about GASB 62, we'll talk about how you can go about that. And then in the financial statements, you show it as an operating expense, or if it's a large amount, a special or extraordinary item in the statement of revenues, expenditures, and changes in net position. So here's a real example that you can follow. So here we have a power plant. Our production cost per megawatt hour is $75 a megawatt hour, or $75 a megawatt rather. The market cost is 40. And based on our study, this differential will continue over the life of the unit. Our unit life is 40 years, and we're in year 20 right now, so we're halfway through. So our power plant had an original cost of $20 million. We're halfway through. Straight line depreciation would be 50% of that, $10 million. So right now we have a book value of $10 million of that asset. Okay? And we determine that we can't recover the rest of that cost, so we're going to book an impairment of $10 million. You book it to non-operating expense for 421, and you have to write down the asset to its current value, which is 0 based on our analysis. Again, a very simplified example of the approach that you would take. There would be still some value left in the asset for the hard parts of the assets, the scrap, all of that if you decided to tear it down, things like that. Okay. And the loss is non-operating. You present it as a deduction from operating income as the impairment is non-operating. And again, if it's material, you record it as a special or extraordinary item. So we have in our fictitious financial statement, we have operating income of $30 million. We have an operating or non-operating impairment loss of $10 million. So our net income or change in net position is now $20 million. Well, what if we're still using the unit? Well, you can still use the unit and it can still be impaired. So we use this power plant and we say, well, it's good for backup. So what we would do would be to determine what is the value of that unit as a backup unit. And we still would probably impair part of the value of the asset. And in that case, it's still in service. You would have improvements to it, capital improvements to keep it running, things like that. So any capital additions to the units in the future would also be recorded as an immediate impairment. And GASB 42 goes on to say the types of impairment, they call some impairments temporary. Well, temporary impairments are not really impairments because you don't book anything. What you're doing is recognizing that a temporary impairment can someday turn into a permanent impairment. And when you have a permanent impairment, the asset is written down to fair value and you can't go back. So when you do this, you want to be totally sure that this is what you want to do, and then that is the situation. So again, no implications for a temporary impairment. And a permanent impairment, you can no longer include the asset impairment amount in customer rates unless we go back and use GASB 62, which we'll talk about a little later. Now in the statement of revenues expenditures, and changes in net position, or AKA your income statement. Down here we have a utility that retired a power plant, recorded an impairment. It was a nuclear plant. Put another 3 zeros on this number, so it was almost $1 billion, which is why it's a special item and a large write-down of that. And you put a note in the financial statements that says what makes up that amount, what are all the pieces and parts, and so on. And you see that here as well. So the key takeaway for GASB 42 is this: the impairment impacts the entire financial statements, and your note disclosures should detail the components of the calculated impairment. So, pretty final approach for GASB 42. But then, sometimes we get a little impaired, but we're still useful. What happens in that situation? See you back here in a minute.